So let's go to question 1, accounting. Question 1. It said, are you there? Are you there, please? Are you there? Okay. It said, how would you sell goods for cash? How would the purchaser record this transaction in their books? How would you sales to a purchaser? A purchaser is that individual that buys from How Rogers. Do you get what I'm saying here? How would you sold to you? Let's assume how would you sold to you. So you are the purchaser. How do you record it in your own account? Because you received the product from How Rogers, that means you debit purchases. You debit purchases and you credit cash. You paid cash. And in double entry, you debit the receiver, you credit the giver. Do you understand the point here? So the answer is C. You debit purchases because you received the product from How Rogers, you paid How Rogers, you credit cash. Is it clear? Please take note of that. You debit, don't write anything there, just take note of it. You debit the receiver, you credit the giver. Yes. So that's number 1, C. Is it clear? You debit the receiver, you credit the giver. So that means you debit purchases, you credit cash. Question 1, C. Is that clear, please? All right. Question 2. They said, which of the following pairs of accounts has always have a debit balances? Normally, in accounting, we have assets and expenses. Stop writing, please. Accounts that have debit balances, that means the account that you post on the debit side, debit balances. Expenses have the debit balance. Asset has a debit balance. Capital is a credit balance. Income is a credit balance. Liability is a credit balance. So the one that has both debit balances are assets and expenses. A, question 2A. Is it clear, please? Question 3. They said, where would the trader show trade discount? When I talk about trade discount discounts are deduction you get on your invoice because you have purchased large quantities. That's why you're given a trade discount. Do you get it? So where would a trader show trade discount? The trade discount is shown on the invoice you used. And what is an invoice? An invoice is a document stating that a customer has purchased certain products on credit. So on that product, on that credit, on that invoice, the trade discount you are given for the quantity you bought will be aligned there. So what I'm saying is that on your invoice, when you purchased from your supplier on credit, if you are given a trade discount, you would have been given a trade discount because you purchased maybe large quantities. Are you with me? So the value of that discount will be written on your invoice. So the answer is C. Is it clear? Question 4. It said, a sole trader has included the purchase of the motor vehicle for private use as a business asset. Listen, a sole trader has included the purchase of the motor vehicle for private use as a business asset. So that sole trader has purchased for private use in terms of assets. So we have 2 accounts that we have to record here for the double entry. We're going to have motor vehicle account and we're going to have drawings account. Because when the owner of a business takes money from the business for private use or for personal use, we call it drawings. Are you with me? So we have double entry transaction here, motor vehicle account, which he purchased as an asset, and drawings account. So how do we record it? You debit the drawings account and you credit motor vehicle account. You debit the drawings account and you credit the motor vehicle account. Which answer is that? Yeah, great. Don't do it on there, just leave it. Continue on your paper, please. B. On that paper here, you can just, and I'm going to give you this note anyway. So is that clear, please? Question 4, is it clear? Okay. Go to question 5. It said a trader record. Are you there, please? Question 5. They said a trader records purchases of £250 in his book as £520. What type of error is this? A trader records purchases of £250 in his books as £520. Is it commission? Is it compensating? Is it original entry? Is it principal? We have different types of errors. I'm going to explain that maybe after this. But for this transaction, recording 250 for 520, it's error of original entry. That means you record it at the beginning of the transaction. Instead of recording 250, you recorded 520 for the transaction. So we call it error of original entry. Original entry means at the beginning of your transaction. You make the mistake from the beginning. So it's error of original entry. Is it clear? So the answer is C. For error of commission means, I just want to quickly explain this. Error of commission means you recorded the account into the right, you recorded the right transaction, the right account, but to a different class of account. That means what I'm saying is, instead of recording into Bisan's account, I recorded into Bayan's account. So the name, the classification of account is different, but the account was recorded correctly. I want to record $50 for you, but your name is Bisan, but I recorded it in Basan's account, mistakenly recorded it in Basan's account. The account will still balance, but it's just that the wrong classes of account has been recorded into. Do you understand? So that is error of commission. For compensating error, it means on your debit side, you understate your debit side for $100 and overstate your credit side for $100. The 100 will cancel this 100. That is compensating error. Do you understand what compensating means here? You made a mistake on the credit side of $100. At the same time, you made a mistake on the debit side for $100. So the 100 will cancel that 100. That is compensating error. Is it clear? Then error of principle. We're talking about error of principle. That means you mistakenly use what you're supposed to put on the debit side, you put it on the credit side. And what you're supposed to put on the credit side, you put it on the debit side. Your transaction will still balance. Is it clear? Is it clear, please? Another example for error of principle is when you recorded expenses as assets and assets as expenses. Both of them are debit entries, so your account will still balance. Do you get my point? With assets and expenses are debit balances. For example, motor vehicle. Motor vehicle is an asset. Motor expenses is an expenditure. Motor vehicle, when you purchase a motor vehicle, it's an asset, a debit balance. When you maintain the motor vehicle, whatever you spend on that motor vehicle is an expenses for the business. Do you understand the difference here? Asset is when you purchased the motor vehicle. When you purchase an asset, it's a debit balance. When you continue to maintain that asset, it's an expenses. It's also a debit balance. So instead of you to record motor vehicle into an asset, you record it as an expenses. Your account will still balance because both of them are always on the debit side of the transaction. Is it clear? So that's question 5. Go to question 6. They said, which of the following transactions would affect a business's profit? Sale of fixed assets at book value. That would not affect your profit. Settlement of business debt with discount. Yes. Settlement of business debt in full. No. Because when you settle your business debt in full, you don't have any interest to pay. You don't have anybody to pay anymore. Transfer of cash to the bank account. It's a contra entry. Nothing is happening. So the answer is B. Is it clear? We go to question 7. It said, at the end of the financial year, are you there, please? Question 7. It said, at the end of the financial year, the trader added monies as outstanding for rent to the rent amount paid during the year to obtain the total rent for the year. Which accounting concept was being adhered to? We have accrual, we have business entity, we have going concern, we have materiality. Let me explain each one at a time. When we talk about accrual means your expenses for this year, you match it with your income for this year. So what comes into your account this year, you match it with what you are spending this year. That is accrual matching concept. Business entity, it means you separate the business from the owner of the business. So when the owner of the business takes money from the business, you record it as drawings. When the owner of the business puts money into the business, you record it as capital. That means the owner of the business is different from the business. Are you with me, please? I'm talking about B, business entity. I'm telling you the difference between each accounting concept. The first accounting concept is accrual. Can you get in there, please? Question 7. Do you see accrual there as A? I explain what accrual is. Accrual means you are matching the expenses with the income, the assets with the liabilities. So you don't, whatever happens this year, you end it this year. Don't take it over to next year. So if you are making so much profit this year, remember that you have expenses to take care of too. Don't think about the expenses for next year. Think about the expenses also for this year. That is accrual. Then we have business entity. For business entity, it implies that you, as the owner of the business, you are different from the business. So whenever you take something from the business, you record it as drawings. Whenever you put capital, cash into the business, we record it into the business as capital. So it means the business is different from you, though it is your business, but you must run it as if you are not the same as the business. Incorporated, incorporated businesses, yes. But what we're saying here is they are incorporated businesses because they are different from the owners of the business, right? But what I'm saying here is that the incorporated businesses are private limited companies and public limited companies. But here, you might be a sole trader and still run your business separately. Do you get it? So that is what we talk about business entity. The owner of the business is different from the business. So if the owner of the business takes money out of the business, you record it as drawings. If the owner of the business puts money into the business, you record it as capital. That means the owner of the business is separated from the business. That is B. C, going concern. Going concern means a business must be run as if it will never end. You run the business as if it will last forever. You don't start a business to end it tomorrow. You start a business as if even the generation unborn can still continue the business. That is going concern. Is it clear? The materiality. Figures, you must be able to record every transaction. Whatever you buy, whatever you purchase in accounting, you must be able to record them. So based on this transaction, they said at the end of the financial year, a trader added monies outstanding, what he is owing for rent, to the rent amount paid during the year to obtain the total rent for the year. So it means the owner of a business ensures that the money he is owing, he paid it, he fully paid the money. So that means accrual matching concepts. The money he is owing, he paid it to get, like, I am not owing anymore. My expenses, my income, I have finished it. Everything is set. That is accrual. 7A. Is it clear? Question 8. He said, to whom do the reserves in a limited company belong? When you have reserve in a limited company, it belongs to the owners of the business, the investors, which are the ordinary shareholders. Are you with me? We have the ordinary shareholders, D, question 8, because they are the owners of the business. Question 9. Where on balance sheet would a proposed dividend be shown? What is a proposed dividend? A proposed dividend is a dividend declared to be shared among shareholders of the company. A dividend is a share of profits made by the business to shareholders. Because a company, a limited company, would have shareholders. So these shareholders, they have invested into the company. Yes or no? So the return on their investment, what they get back from investing into that business or from having shares in that company is called dividends. They wouldn't get dividends until the company declares profit. So if the company declares profit for the year, then they will be able to give dividends to shareholders. So that is for dividends. For proposed dividends, I wrote, is the dividend declared to be shared among shareholders of the company. So dividends that is being declared, like we have to give these dividends to the shareholders. That is proposed dividends. Is it clear? So no, as a company, yeah, no, it would have been decision of the directors. It would have come as a decision by the directors. Do you get it? So they decided to share these dividends, that profit made amongst shareholders. So that is a liability to the company, and it's called current liability. It's a current liability, so it's B. Is it clear? So, question 10. They said, the following information was extracted from the accounts of Simba Limited. Sales for 2016, £120,000, and in 2017, £140,000. Gross profit percentage, 20%. In 2016, 25% in 2017. The net profit percentage, 10% in 2016, 8% in 2017. What conclusion can you reach about Simba Limited? Based on what I've seen here, though sales increased from 2016 to 2017, the gross profit margin increased from 2016 to 2017.
What's the gross profit?
Gross profit is your revenue minus your sales. Your revenue minus your cost of sales. Revenue minus cost of sales is gross profit. I'm going to write that for you. Gross profit is revenue, which is the same as sales. Revenue minus cost of sales. Then the gross profit percentage. The gross profit percentage has its own formula, which is revenue divided by sales, revenue divided by gross profit. Gross profit percentage is gross profit divided by sales multiplied by 100. That's the gross profit percentage. The net profit percentage is net profit divided by sales multiplied by 100. That's how they get the percentage. So based on what we have here, I wrote the formula for you already. For net profit percentage or margin, it's net profits divided by sales multiplied by 100. So based on what we have here, and how do we get your net profit? The formula for net profit itself, net profit equals to gross profit minus expenses. So these are the formula. So based on what we have here, the gross profit increased from 2016 to 2017, but the net profit reduced in 2017. Yes or no? So we have to go back to the formula of a net profit. The formula for net profit is gross profit minus expenses. So what would have made your net profit to reduce is because you have more expenses. Listen, your net profit is your gross profit minus expenditures. That's how you get your net profit. So if your net profit has fallen, it would have been as a result of expenses increasing for your business. So if your expenses increased, your net profit would fall. So if your net profit falls, your net profit margin or net profit percentage will also what? Fall. So let's check the options here. Closing stock has increased, no. Expenses have increased, yes. Because we get our net profit through what? Gross profit minus expenses. So based on what we have here, if the net profit percentage has fallen, it would have been as a result of an increase in expenditures. Is it clear? Is it clear, please? Question 10, it's B. So go to question 11. It said, Selena Gomez owns a wholesale electrical supplies business and sells mainly on credit terms. He is a credit supplier. He sells on credit, or she sells on credit. So, it said, complete the following table to show the book of original entry in which each transaction will be entered. So, for each transaction that was done, how will Selena record it in her accounts? So, we start. Sold goods on credit. When you sell on credit, that means you sold. So the book of original entry is your sales book. What do I call it? Sales book. That is the book of original entry. When you sell on credit, you record it in your sales book or sales journal. 2, sold sales books, yeah. Sales book. Don't worry, I have the note for you here. I have the note. 2, sold goods for cash. When you sell on cash, the book of original entry will be the cash book. That means you record it in your cash book. Is it clear? 3, purchase the fixed asset on credit. When you purchase a fixed asset, she purchased a fixed asset on credit, it will be recorded in the journal. To be recorded in what? In the journal, purchases journal. Then, return goods to a credit supplier. She returned to a credit supplier. That is purchases returns journal. To be recorded in purchases returns. Then, pay the credit supplier by bank transfer. You pay your supplier through bank transfer. It will be recorded in your cash book. Is that clear? Great. Go to question 11B. It said, on September 1, 2017, are you with me?
Yeah.
On September 1, 2017, her purchases ledger contained the following credit. So this is still Selena. Are you with me? So on September 1, 2017, she has all these credit customers or credit suppliers. She purchased from all these suppliers, Alba, Brown, Qatar, and Davis. Then at the end of September 2017, she extracted the following information from her records. Purchases on credit. Purchases on credit, in your purchases ledger account is going to be a credit balance. When you purchase on credit, it's going to be on the credit side of your purchases ledger. Payments to credit supplier. You paid your credit suppliers. It's going to be on the debit side of your purchases ledger account. Please put it in your mind. The first transaction, purchases on credit, is going to be in your purchases ledger as a credit balance. Payments to credit supplier, you paid your credit suppliers. It's going to be on the debit side of your purchases ledger. Debit side of your purchases ledger, when you open the account, you're going to open an account for this. The third one, return to credit suppliers. You return to credit suppliers. That will be purchases returns. Your suppliers received it. It's going to be a debit balance on your purchases ledger. The next one, interest charged by credit suppliers. You have to pay your credit suppliers interest. Maybe because you didn't pay earlier. You paid at a later date. So that will be a credit balance on your transaction. We call it interest charged. Then the last one, sales ledger balance set off. Are you there? Sales ledger balance set off. Set off means I purchased something from you. You purchased from me. Maybe I purchased goods of 500 from you. Then you purchased goods of 600 from me. I'm owing you 500, you are owing me 600. So instead of me to pay, you take 500 from 500, that means you're going to pay me 100. That is set off. You understand what set off is now? So when there is sales ledger balance set off, you record it in your purchases ledger control account because you have paid, you have deducted the amount your supplier is owing you to pay your supplier the leftover of that transaction. We call it set off. So sales ledger balance setup will be recorded in your purchases ledger control account at debit side. Are you with me? Now, how do we open this transaction? Now we have to post this transaction. Yes, it said prepare a purchases ledger control account. There, are you seeing it? So the first thing we have to do is the total number of suppliers. We have, go back to the first page. We have the total number of suppliers. We have 1,266 from Alda plus 3,478 plus 2,188 plus 1,068. Do you get them there? So that gives us 8,000. So our balance brought forward will be 8,000. You put that on your credit side of the purchases ledger. So your purchases ledger, now go down to your purchases ledger. The debit side is on your left side. The credit side is on your right side. Are you there? So we start September 30th. For September 1, on your credit side, you have balance brought forward, 8,000. Balance BF, 8,000. The total of all the suppliers, 8,000. Then we have September 30th, the cash book. Our cash book where we have our credit transaction. Payment on credit suppliers. We paid our credit suppliers 15,422. Can you see it there? It will be recorded in your card as a cash book in your purchases ledger, debit side of the transaction. So you write September 30th, cash book, 15,422. Don't worry, I have it here. Just listen to it. Just check and look at it. Then the next transaction will be September 30th, purchases on credit, amount 21,786. It's there. You record it on the credit side. Then the interest charged of 184. Interest charged of 184 will also go to your credit side of your purchases ledger. So your total will be 8,000 plus 21,786 plus 184. So the total on your debit, on your credit side will be 29,970. Leave that aside. 29,970. Now we go to the debit side. For the debit side, we have our cash book for 15,422. Purchases returns. Purchases returns of 1,731. That's returns to credit supplier. You can see there. 1,731. So we have 15,004. Hold on, please. 15,422 plus 1,731. These are our debit transaction plus the balance set of 650. 650. It gives us 17,803. 17,803. So you take it away from the credit side minus 29,970. That gives us 12,167. So your balance carried down on your debit side will be 12,167. So when you add them together, the balance on your credit side will be equal to your balance on the credit side. The balance on the debit side will be equal to the balance on the credit side for 29,970. Then on your credit side, you carry it will be balance brought down. Here you have your balance carried down as 12,167. In your debit side, in your credit side, you're going to have it as the end of September is October. At the end of September, we go to October 1. So October 1, we have balance brought down of the balance carried down of 12,164 on your credit side as 12,167. Is that clear? Then the last question for 11C, before we stop this lesson, it said, explain one error that would not be identified by preparing the purchases ledger control account. Errors that would not affect our accounts. We have error of commission. Error of commission will not affect error of commission, error of omission, compensating error, error of principle. They would never affect your trial balance. And if they're not going to affect the trial balance, they will not affect your purchases ledger. Are you with me? So for error of commission, they said explain one error. So I choose error of commission. So for error of commission, I wrote Here, the current amount is entered, but in the wrong classification of account. I told you earlier. Instead of recording it in the Sam's account, I recorded it in the Sam's account. So it will not affect the purchase ledger. Any question about it? Any question about it? Which one? Error of commission. So they said question C, 11C. Yeah, it's just I could choose error of commission. I could choose error of compensating. Yeah, they only want us to state one type of errors that would not affect our transaction. We could choose error of commission. We could choose error of commission. We could choose error of original entry. We could choose compensating errors. Just choose one and explain how. Is it clear? Any question now? All right. So we stop this lesson first. So that's the part 1.